Hello everyone and welcome to Virginia International University's MBA 636 Managerial Accounting course. Today we're going to be talking about Chapter 7 from our text, which deals with cost, volume, profit, or CVP analysis. Managers use this CVP analysis to help understand some of the mix of business and how sales influences or sales volume influences the contribution margin ratio, how those in conjunction with fixed price influence the number of units needed to be produced to break even. How does the target profit fall into all of this? So this has a lot of analytical use for managers, this idea of cost, volume, profit, and so we'll be talking about that through this chapter. So first we want to understand how to calculate the unit contribution margin and the contribution margin ratio. So when we talk about cost, volume, profit analysis, remember in Chapter 6 we discussed cost behaviors and methods that we can use to determine how a company's cost behavior or how a company's costs behave, and that this helps us to deal with helps managers to ID the volume of sales necessary to achieve break-even analysis. With cost, volume, profit analysis, we use it as a tool that helps us to make important decisions, business decisions. It illustrates a relationship among cost, volume, and profit or loss. It helps us to determine how much the company must sell each month to cover these costs or to break even, and it really helps managers decide how sales volume would need to change to achieve the same profit level under other circumstances. So cost, volume, profit analysis really expresses a relationship among cost, volume, and profit, of course. And it relies on the interdependency of 5 components or pieces of information. And these are the sales price per unit. And here we assume that there's no volume discount. So we assume that our sales price is constant over the relevant range. We talk about the volume sold, the variable cost per unit, the fixed cost, and then our operating income. And once we have some of these components, we can solve for others. But these are the key components to CVP analysis. And we have certain assumptions in CVP analysis, and that's that there are no volume discounts, so every unit is sold at the same sales price, that costs are linear throughout the relevant range. And we talked about earlier in Chapter 6 this idea of cost behaviors, and that there could be curvilinear cost lines, there could be step cost lines. The cost, volume, profit analysis deals with linear costs throughout a relevant range. And we can also assume that these costs are either variable or they're fixed, right? We're not going to talk in this analysis using mixed costs. So revenues are linear in relevant range. There again, we get back to the sales price, which would be the same regardless of the number of units sold. We talk that inventory levels will not change. So that assumes that the amount produced will always equal the amount sold. And where we have multiple product lines being sold, we assume that the sales mix will not change. So for instance, if I have 2 product lines and my sales are split 50-50 between the 2 product lines, our analysis assumes that that 50-50 split will continue. And so throughout our discussion, we're going to be using this example using Kay's posters. So Kay has an e-tail poster business. She currently sells each poster for $35, while each poster has a variable cost of $21. There are fixed costs associated with Kay's business of $7,000, and she's currently selling 550 posters. So you see, we've met got a lot of the information that we needed early on that we said we would need to have, right? We have the sales price per unit, $35. We have the volume sold, 550. We have the variable cost per unit of $21, and then we have total fixed cost of $7,000. And of course, with each of those, or with all of those, we could calculate the operating income. So let's go ahead and complete a contribution margin income statement. And remember from our previous chapter that a contribution margin income separates cost by cost behavior rather than function, like the traditional conventional income statement does. So we said we had sales revenue for our contribution margin income statement. We start off with sales revenue. We're told we have sold 550 posters, and she has a sales price of $35 per poster. So that gets us sales revenues of $19,250. We're told that variable costs are $21 per poster. So $21 times the 550 posters gives us variable expenses of $11,550. And when we subtract the variable expenses from our sales revenue, we get a contribution margin of $7,700. And again, what this contribution margin is it's how much of our sales go toward covering our fixed expenses, right? So $7,700 goes towards covering our fixed expenses, which were given at $7,000, and so we get an operating income of $700. So that's the contribution margin income statement for this example. And we think of the contribution margin as the dividing line. With all variable expenses are above that line and all fixed expenses are below that line. And so then we talk about this idea of a unit contribution margin, right? So we know that Kay's ETL posters sold at $35 a piece, less the variable cost per unit of $14 per piece. So we know that we have a contribution margin per unit of $14 that goes toward covering our fixed expenses and any profit we may want. So now we can look at this and say, well, let's assume we have 650 units. Well, knowing that our contribution margin is $14 and we have sales of 650 units, we can say that our contribution margin becomes $9,100. That's the 650 times 14 less the fixed cost of $7,000 gets us operating income of $2,100. So this allows us to quickly forecast income at any volume within the relevant range. And so now we talk about a contribution margin ratio. And when we talk about a ratio, we're talking about a percentage. And in this case, it's the percentage of each sales dollar that is available for covering fixed expenses and generating a profit. So to calculate the contribution margin ratio, we simply take the unit contribution margin of $14 divided by the sales price, which is 40%. So what we're saying is that for each unit, we're generating 40% of each sales dollar that goes toward covering our fixed expenses. For the contribution margin ratio, we can also do it at an aggregated level. If we know that our contribution margin is $7,700, which we calculated early on our contribution margin income statement, and we divide that by the sales revenue of $19,250, which we got by multiplying the 550 posters times the $30 a piece, we get that same 40%. Right? And so, again, what that says for the contribution margin ratio is that for each dollar of sales revenue, we generate 40 cents toward covering fixed expenses and margin. And so next we want to understand how do we use this CVP analysis to find break-even. So the break-even point is the sales level at which operating income is zero. So if sales are above the break-even point, we have profit. If sales are below the break-even, then we have a loss. We want to keep in mind that fixed expenses is equal to the total contribution margin and that total sales equal total expenses. So let's walk through some examples of how to calculate the contribution margin to calculate even. So using the unit contribution margin to calculate break-even points in units, right? So what we want to understand is, well, if I know what my unit contribution margin is, how do I translate that into the break-even number of units I need to sell, or the number of units I need to sell to where I exactly cover my fixed costs but don't generate a profit? So we know that to do that, the units sold have to equal the fixed expenses plus the operating income, right? And if we assume zero operating income, we have our fixed expenses of $7,000 divided by the contribution margin per unit, which we calculated earlier to be $14. If we do that calculation, here's our formula based on K's ETL. And so if we do that formula, we're told that we have to sell 500 posters. So already we know Kay must be making a profit based on this because we're told that she sells 550 posters, right? So now let's talk about how we use the contribution margin ratio to calculate break-even point in sales dollars. Right? We're not now talking about a number of units sold. We're talking about the sales dollars we need to generate in order to cover our fixed expenses. So the sales in dollars is equal to the fixed expenses plus the operating income divided by the contribution margin ratio. And you'll notice that this is almost exactly the same formula that we looked at earlier. It's just now we want to calculate what sales we need in dollars to break even versus the sales that we need in number of units to break even. So if we work on the same assumption that our operating income is 0, we're back to using our fixed expenses of $7,000 divided by the contribution margin ratio of 40%, right? And we calculated that earlier. And when we do the math on this, what we end up getting is $17,500. So what that says is that we need to have sales of $17,500 in order to cover all of our variable costs that follow those sales, plus the $7,000 in fixed costs, and we are at break even. We've covered all of our costs and we've made no profit. Not ideal, but it also beats the alternative of not covering all of our costs. So now what we want to do is assume that we want to make a profit. That's a fair assumption, a legitimate concern. So in that case, we want to find the volume that we need, including a target profit using the unit contribution margin ratio, or I'm sorry, the unit contribution margin. So to do that, we again go back to the units to be sold must equal the fixed expenses plus our operating income divided by the contribution margin per unit. And let's assume that we want to recognize $4,900 in operating income. So our formula would be the same as it was before. It's just where we had 0 before an operating income of now we have $4,900, which gives us total fixed expenses plus operating income of $11,900 divided by the $14 contribution margin per unit to get us to 850 posters. So if we sold 850 posters at $35 a poster, we would have $29,750 in sales revenue, and that's what we would need to generate then, $29,750. We would need to generate that in order to cover $7,000 worth of fixed expenses, all of the variable costs that are associated with the $850 posters, and have $4,900 in operating income achieved. So you can see it's the same formula as what we had before. We just had earlier assumed 0 operating income. Now we're saying, no, we want to earn $4,900 in operating income. So you can see, again, this gives us a very quick way of determining some answers to volume, some volume considerations if we're looking at particular cost behaviors. So let's do the same thing now, finding the volume needed for target profit using the contribution margin ratio, right? So now we're not talking units, we're talking sales dollars. So CVP analysis helps us to determine what we need to sell to earn a target amount of profit. And our formula, if you recall, is sales dollars needed is equal to the same fixed expenses plus the same target operating income, but divided by the contribution margin ratio, not the contribution margin per unit. So if we make the same assumption that we want $4,900 worth of operating income and we have to cover our $7,000 worth of fixed expenses, we get to the formula of 7,000 plus 4,900 divided by 0.4, or the contribution margin ratio. And so you can see we get to the exact same answer that we had before, $29,750 in sales in order to, in sales dollars, because before we calculated how many units we needed to produce, but we translated that into dollars, so we have the same revenue number we need in order to cover the $7,000 in fixed expenses and the $4,900 in the targeted operating income. So now we want to graph these relationships that we have. The first step is that we choose a sales volume. Then we plot a point for the total sales revenue, and then we draw a sales line from the origin through the plotted point. And so you can see here we've said, well, if we sell 1,000 units, right, And we multiply that. In this case, we're talking $100 per unit. Then we would end up at $10,000 in revenue. If we compare that, and let's just assume that we have fixed costs of $4,900, right, or $4,000, I'm sorry, $4,000, that's our fixed cost, the blue line. So we're assuming, now this is not the same, I'm sorry, not the same example we were looking at earlier, but we have $4,000 in fixed cost, and we remember that on the x-axis we have volume, on the y-axis we have dollars, and we're saying that, well, fixed cost is a straight line with no slope, because whether we produce 0 or 1,500 in this example, we're going to have $4,000 worth of fixed cost. Then we have to graph our variable costs, right? And so, or we have to layer the variable cost onto the fixed cost to come up with total cost. And so our green line becomes our total cost line. Okay, so we have revenues, which we graph based on the volume of units sold, and the revenue that generates. And again, remember our assumption, straight line, right? Every unit is sold at the same price, so that would be a straight line. We have our fixed cost, which we talked about earlier, a straight line, the point of origin, or where they intercept the y-axis. We are not assuming any curvilinear relationships. We're not assuming step relationships with respect to cost behavior. And then we have total costs, which are our fixed costs plus our variable costs. And total cost and variable costs always intercept the y-axis at the point of fixed costs, right? Because that's where we have no where we have 0 units, we have 0 variable costs, but the total cost is fixed plus variable, so it has to include the blue line for fixed costs. And so when we do this now, we've got the makings of figuring out, well, so where are we with respect to break even, and then what represents profit and what represents loss with respect to this graph. And we do that in this slide, where we are identifying the break-even point and the areas of operating. So the break-even point is where our total cost intercepts our total revenue. So that's the green line, right? So where the green line intersects the red line, we're at a break-even point, because that's where total cost, green line, is the same as our revenue. Where we sell more units than that, we generate an operating income, right? Because at that point in time, we've covered all of our fixed costs. So any unit sold above the break-even point, after we reduce the sales price for the variable costs, we end up with something left that would normally cover fixed costs, but those have already been covered, so that becomes operating income. And the same argument with respect to the operating loss. If we don't sell enough units to cover our fixed costs, then even though we've covered all of our variable costs, we haven't covered all of our fixed costs, so we're at an operating loss. And so this just kind of helps us visualize this relationship and what the cost volume profit chart would look like. And so now we want to talk about this idea of sensitivity or what-if analysis that managers are performing in order to help make better decisions. So managers need to be prepared for increasing cost, right? Because that's just going to happen. We need to be prepared for pricing pressure from competitors to constantly bring down our prices to match the market and other changing business conditions. We get to one way of helping to cope with that is through this use of sensitivity analysis. And so this helps. Sensitivity analysis essentially amounts to what-if analysis. And so it helps us answer the questions like, what if the sales price changes? What if our costs change? Or what if the sales mix that we have changes? Now, I know early on we said the assumption was that with cost volume profit analysis that the sales mix doesn't change, but with sensitivity analysis we're able to factor some of that into our decision making. So if we talk about what would happen if the sales price changes, well, we know that if from the contribution margin income statement, if the sales price changes and our variable price remain constant, we're going to have a change in our contribution margin, right? And if we have a change in the contribution margin, whether it's the per unit contribution margin or the contribution margin ratio, we're going to have a break even or a change in the break even point. And so to solve for this, what if the price changes, we calculate a new unit contribution margin to compute break even sales in units. We can then use the new unit contribution margin to compute break even sales in dollars, or we can use the unit contribution margin to create the break-even point in using an operating or target profit. So we have a lot of use for this, sensitivity analysis in answering the question around what if the sales price changes, because we know that under that scenario the break-even point will change. So then what do the variable costs change? Well, again, if our variable costs change, but our sales price doesn't change, we're just saying the variable costs change, we know, according to our contribution margin income statement, would you expect if variable costs change, would you expect a change in the contribution margin? And I hope you answered yes, because if our variable costs change and our sales price doesn't change, it may be an increase or a decrease, but we would have a change in our contribution margin, both the contribution margin per unit in dollars and the contribution margin ratio. Because we have that, we're going to have a change in our break-even point. So if we have a decrease in fixed dollars, we will yield a lower break-even point. If we have an increase in fixed dollars, we will yield a higher break-even point. And so again, we talk about what happens with fixed costs. Well, so fixed costs, because they come beneath the dividing line, right? They're beneath the dividing line. They do not affect contribution margin, right? But would you expect that they would change the break-even point? And I hope you said yes, because they will. And again, as we said earlier, if we have a decrease in fixed cost dollars, we'll have a lower break-even point because we have lower costs that we have to cover via the use of the contribution margin, either per unit or contribution margin ratio. And so the number of units we'll need to sell to cover those costs will be less. If we have a higher fixed cost in dollars, we'll need to sell more units of production in order to cover those fixed costs. So again, these are just some examples of the what are the different ways that this sensitivity analysis helps managers. So we always want to kind of keep in mind this idea of sustainability in CVP. So keeping in mind that, of course, reducing costs and helping the environment, and the text gives us some examples of how Coca-Cola, some actions that they did that kind of increased their profitability, but at the same time helped the environment. And by increasing their contribution margin, it made it easier to reach target profit. But at the same time, it's it shows concern. It addresses social responsibility issues. It addresses shareholders who have a strong sense of social responsibility, all of which tend to be generally thought of as favorable for our stock prices. So I know early on we talked about assuming a sales mix would not change, but what if we do have a company that has multi-product lines? So perhaps they produce product A and they produce product B, and each of those products has a different contribution margin. How would we go about determining, making some decisions and some what if analysis around that? So let's walk through an example. So using the same K's e-tail posters that are given in Exhibit 7.8, we see that we have a sales price. K produces two posters, regular posters and large posters. Sales price for a regular poster is $35, for a large poster is $70. The variable cost for regular is $21, yielding a contribution margin per unit of $14. And the variable cost for large posters is $40, yielding a contribution margin per unit of $30. Their current sales mix is that they sell 5 regular posters, and so that generates a contribution margin of $70 and they sell 3 large posters, which generate a contribution margin of $90. So in total, they sell 8 posters. 5/8 of them are large. 5/8 of them are regular. 3/8 of them are large. The total contribution margin generated by that sales mix is $160. When we divide that by the total number of posters sold, we calculate this weighted average contribution margin per unit. So to find the sales volume, we must know or estimate this weighted average contribution margin. And as we did just now, this is simply calculated by dividing the total contribution margin by the number of units sold. So again, if we're looking at the units, how many units must we sell, we can calculate that by taking the fixed expenses plus the operating income divided by the weighted average contribution margin per unit, right? And when we looked at using the same example, we had 7,000 and we assumed 0 operating income. We have a contribution margin from our previous example, a weighted average contribution margin of 20. So that tells us we need to sell 350 posters. And in that scenario, we assume the mix or the sales mix stays the same. Okay, and so assuming that our sales mix stays the same, and we know that we have to sell 350 posters given what the weighted average contribution margin per unit is, that we have, so how many regular posters and how many large posters do we have to sell? Well, we have 300 in total, no change to the mix, so 5/8 of the 300 is 218.75, and 3/8 of the posters are large posters times 350, so we get 219 regular posters because we can't sell a partial poster, so 219 regular and 132 large posters. And so that's the break-even point in sales revenue using a multi-product firm and the weighted average contribution margin. Right, and we could turn those, we know what the sales price is of regular posters, we know what the sales price is of large posters, so we could turn that into easily into the revenue that each of them. Okay, so the next topic we want to talk about is this margin of safety and operating leverage. So a firm's risk depends on many things, right? On many different factors. What we want to talk about here is what the margin of safety means and what operating leverage means. So margin of safety is the excess of expected sales over break-even sales, right? So if I know my break-even sales is 1,000 units and I'm selling 2,000 units, I have a very wide margin of safety, right? So the further above I am of the margin of safety, the less risky the organization is, right? So the closer we get to the margin of safety, then the more risky it becomes, because if our sales were to drop beneath that margin of safety, I wouldn't either be generating target operating income, or I might not even be covering my fixed cost. When we talk about operating leverage, we're really talking about the relative amount of fixed and variable costs that make up a firm's total cost, right? And the issue there becomes one of, well, so operating leverage is a relative score. And so if I'm highly leveraged, that means I have a lot of fixed costs. And so if I'm highly leveraged, that means that if my sales dip, I may not generate enough income or contribution margin to cover my fixed costs. If I don't have a lot of fixed costs, if I have low leverage, then I'm less risky because my sales can dip. And essentially what that would mean is that I'd have less operating income, but I'd still be able to cover my fixed cost. So again, we talk about margin of safety as being the excess of expected sales over break-even sales. And so from a sales perspective, the higher we are, the further away we are from on the high end of our sales over our break-even sales, the less risky we are. In that case, a drop in sales means that the company could still absorb it before incurring a loss, And it's used to evaluate the risk of current operations as well as the risk of new plans, right? And so this is just an example where we said, well, the margin of safety in units, if we have expected sales in units of 950 and we have break-even units in sales of 500, we have 450 units. If we have expected sales in dollars of 33,250, but we need break-even sales of $17,500, we have a margin of safety in dollars of $15,750. So we could do the same, we could calculate the same margin of safety as a percentage, and that's just simply the margin of safety in units divided by the expected sales in units. So the 450 units of margin of safety in units plus divided by the total expected sales in units gives us a 47.4% margin of safety. Exactly the same thing, margin of safety as a percentage if we wanted to use dollars. We know we have $15,750 in sales that we could lose without necessarily impacting our ability to cover our fixed cost and our operating cost. And that round comes to the same 47.4%. So now we want to talk about operating leverage. And what this talks about is how responsive a company's operating income is to changes in volume. Right? So the lowest possible value for this factor is 1. And that's assuming the company has no fixed cost. And we calculate the operating leverage factor by simply dividing the contribution margin by the operating income. And so in our previous example, we said that we had if we have a dollar for dollar operating leverage to contribution margin, right, then we have a contribution margin ratio, of 1. Or an operating leverage, I beg your pardon, an operating leverage factor of 1, which tells us that, for every dollar in sales that we lose the ability to cover, the same ability to cover our fixed expenses by that amount. So let's look at a different example where we have a different operating income target. Again, operating leverage factors how responsive a company's operating income is to changes in volume. The lowest possible value for this factor is 1, and that's if the company has no fixed cost, right? We take the operating leverage factor, we calculate by dividing the contribution margin by the operating income. If we assume that our operating income in this case is $6,300, we have a 2.11 rounded operating leverage factor. And so a couple of comments about how high operating leverage companies, what it is about high operating and what is it about low operating leverage companies. So high operating leverage companies have higher levels of fixed costs and lower levels of variable costs. They have higher contribution margin ratios. They are higher risk, and again, we say they're higher risk because we say if sales drop, we have these fixed costs that must still be covered, and so if sales volume drops, there's the chance that it'll drop so much that we won't be able to cover the high level of operating leverage that we have in place, right? And in this case, so for companies that are high operating leverage type companies. But we also have a higher potential for reward because once we've covered all of those, all of that operating leverage, right, all of those fixed costs, we have the, every dollar after that is a dollar straight to operating income. And so now we talk a little about low operating leverage companies. And these low operating leverage companies have higher levels of variable costs and lower levels of fixed cost, right? So in this case, the dividing line at where we have higher levels of variable costs, what's the contribution margin in low operating leverage companies will tend to be less. So they have lower contribution margin ratios. So for low operating leverage companies, changes in volume do not have as significant an effect on operating income, right? Because I don't incur the same level of variable costs. So if my sales decrease in a low operating leverage company, I'm not incurring the same level of variable cost, right? And so under that scenario, we generally have a lower risk, but we also have a lower potential for reward. And a good example of these low operating leverage company or merchandising companies where they have such small markups on their product, that they have this the variable costs associated with them are very high, and the low contribution margin. It's just a very low contribution margin that merchandising companies, think of grocery stores that sometimes return fractions of a cent on products that are sold. So that finishes up Chapter 7 for us. I hope that was helpful in understanding cost, volume, profit analysis. Again, I would say if it's not, please make sure you read the chapter first. If there are any questions about it or if anything isn't clear, don't hesitate to email me or contact me via phone. I'm happy to talk through any of these concepts again, but just don't let this video substitute as a read for the chapter. And I appreciate your time then, and thanks very much. I look forward to talking with you about Chapter 8.